Hello everybody, it's Paul here. It is Monday the 8th of October. Hope you can all hear me, hope you can all see my screen. Okay, here we are ladies and gentlemen for the, I think it's the 11th episode of Mastering the 4Ms of Trading, our session about helping you develop an understanding and a mastering of those 4Ms of trading. As always, we look to begin with a quick risk disclaimer. Forex and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 83% of retail investor accounts lose money when trading CFDs with Admiral Markets UK. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Please ensure you fully understand all risks involved. Forex and CFD trading is a risky activity, and this presentation and accompanying video should not be taken as advice for investing, as they only represent the personal opinion of the authors. The presentation and accompanying video is for information and educational purposes only. As of August 2018, the regulation within the European Union differs for retail clients and professional clients. In our presentation, we use demo trading accounts where all clients could still use a high leverage in a risk-free environment. Before opening a live trading account, please consider the differences between retail and professional trading terms. Retail clients benefit from an unlimited negative balance protection. Professional clients at Admiral Markets UK receive a compensation of account deficits with the maximum payout of £50,000 sterling as per our negative balance protection policy. Why would you trade with Admiral Markets UK? Well, Admiral Markets provide a wide and diverse range of products and services, and some of their best offerings being DAX 30 and Euro Dollar. There's normally a typical spread of 0.8 points during the main trading hours. And they also provide the MetaTrader MT4 and MT5 platform with their own Supreme Edition. If you have any questions about Admiral Markets or the platforms, then by all means get in touch with your account representative, and they'll be very happy to talk and guide you. So, ladies and gentlemen, as I said, Paul Wallace. Okay, I'm describe myself as a discretionary-based method trader, which I'm going to be explaining to you that over the range of this series. Primarily, I like to be a dominant trend swing trader who uses just has a very simple approach that merges a mixture of fundamentals, technical, sentiment, and geopolitics. Primarily, I will aim to trade FX indices and commodities. I may touch upon equities and fixed income during our sessions here, just as for examples. And ideally, I'm looking to buy strength and sell weakness. And I personally like to use pullbacks for entries. I will trade some breakouts, but I've found over the years that I personally prefer to trade pullbacks. For my intraday trading, which will be the sort of latter half of our series, then I'm actually primarily a mean reversion trader and looking to sort of trade momentum setups there when they set themselves up. So, that gives you a little bit of insight into how I view the market, which kind of gives us, maybe a little bit of understanding of sort of some of the ideas and methods that we'll talk about over this session and the sessions in the future. As always, I look at my expectations for our sessions is that it's my role here to educate about the 4Ms of trading so that you're in a position to go away and analyze any market, be ready to trade it, and also to help raise your own self-awareness about how you go about managing risk and also managing yourself. For yourselves, ladies and gentlemen, as I say every week, I appreciate we have a broad range of experience in the room, and we also have time limitations of 45 minutes. So I would ask you to forgive me because sometimes I can't go through the breadth and depth of topics that I appreciate everybody would like me to go through because of those limitations. But I will always try and use focus on tools that you can use tomorrow. I appreciate that's the most important thing. I want you to be able to look at a session, okay, whether you're watching the first one or the 11th or the 100th, and be able to sort of take away a tool that you can use tomorrow in your own trading. That's what I think the benefit and the value is for yourselves as customers of Admiral Markets. So, hopefully if you're completely new to the sessions, the Mastering the 4Ms was all about understanding those 4Ms of trading: markets, method, money, and myself. If you look at session 1 that we delivered in way back months now, and which will be in the Admiral Markets webinar archive and on their YouTube channel, on the Facebook page, that I went into a little bit of depth about what those 4Ms meant and went through each particular one of them. For the last couple of months, we've focused mostly on markets and method, and today we're going to draw together sort of some of the elements that we've talked about over the last few weeks with regards to method, and then next week will be an overall review of the methods we've talked about, and then going forward there for the rest of this calendar quarter, we'll be looking to focus on money, and in particular risk management and trade management. And that's really behind the whole of these sessions, is sort of just trying to help educate you and help bring knowledge to you that you can utilize in your own development as a trader. So, remember, you've heard me talk about it every week. I always have a little recap every week, just because, the more times you hear this from me, the more it sort of sinks into you, the more it becomes about your trading routine and processes, which when we get to focusing on the 4th M about managing myself become more apparent as to why we repeat some of the elements of these sessions every week, and I talk about its importance of having a good routine, good processes, good checklists that you can utilize to make sure that you're doing the right thing trade after trade, okay, until it becomes an automatic process for yourself. So we've talked about this, you've heard me talk about these sort of very simple steps: defining levels of support and resistance, defining if there's a trend, looking for how price reacts at key support resistance levels, looking for particular price action signals at support and resistance levels, which is what we've been focusing the last few weeks, excuse me, and then we will be looking at, does that actually build up as part of a bigger chart pattern, which will probably be next week and maybe the week after session, depending upon our times. So, we'll talk about step 1. Whenever you open a chart, all right, I don't care whether you are an intraday trader of Bitcoin, whether you're a swing trader of gold, whether you're a monthly trader of dollar. What we want to be able to do is to define levels of support and resistance, all right? Look at monthly, weekly, and daily charts and start drawing in those horizontal levels of support and resistance, which may also include psychological round numbers. And also, we talked about in, I think, maybe session 2 or 3, that how you can use fractals, which is an indicator on the Admiral Markets MetaTrader 4 and 5 platform, to sort of help draw your eye towards particular levels that would be of interest to us as traders. Once then, the important thing is, we want to see, can we define a trend, right? I said, to begin with, okay, as we started these sessions, we would ideally be looking at being sort of, longer term trend traders, but everything that I share with you is what I like to think of as being instrument and time frame agnostic, namely, you being able to define levels of support and resistance and define a trend. It doesn't really matter what you trade. These are good habits, okay? These are good habits to build. And in particular, when it comes to step 2, defining a trend, I need to know as a trader, you can show to me how you can identify whether an instrument is trending or consolidating, and that's the very basics of it, okay? And every week we talk about how you can see on this chart on the bottom left, we can see that that during that period on that DAX weekly chart, price was consolidating, price was in a range, so you need to amend your approach accordingly. And then once it breaks out, well, then actually we see it in a very nice trend, and you hear me say it every week that good trends leap off the chart at you, okay? Don't force it. Don't try and force it, ladies and gentlemen, all right? If as I said, a good trend will leap off the charts at you, okay? You don't need to force it at all. We also talked about, one of the sessions we covered moving averages, all right, and we talked about how we don't use them like most people would. A lot of new traders will use them for sort of moving average crossovers as a particular trading strategy, as a general rule. That's not really a terribly smart way to trade, because moving averages, they look great in a trend, but you'll get chopped about when markets consolidating. But what they can do is they can give us an indication that we that we are in a trend. They might give us an indication of the kind of the speed and the velocity of that trend, and also it might provide particular areas and levels where they become what we call dynamic support and resistance. Whereas when we're drawing on horizontal levels of support and resistance, they're pretty static, as in they don't move. Whereas actually what we find is, because of course the moving averages are constantly being updated, we find that they act as dynamic levels of support and resistance because they're constantly moving and updating. But that can actually be very helpful, useful information for us as traders. Step 3 was about, we wait to see how price reacts at key support and resistance levels, all right? And that actually, that does require a little bit of patience, okay? And sometimes new traders may struggle with a little bit with patience because, of course, they look at the charts, they see everything moving fast, and of course, they want to be engaged, they want to get on with it. But the sort of let's say the kind of more mature, experienced traders in the room will realize that patience becomes quite key. Actually being able to wait for our particular setup. And what we're really looking for is we're looking for a confluence of events to happen at key levels. What does that mean for a completely new traders? Well, that means I'm looking for somewhere between 2 and 4 things to happen at the same time and place. It's almost like everything's coming together at a particular point. And when I see that, that actually gives me an indication that, yes, I want to take my trade. Okay, I want to actually be engaged with the market. I'm looking to get off the sidelines and actually sort of take a position in the market. And that's what we're looking to do. And that's what we'll be doing over the sessions. Okay, we'll be looking at how we can do that on in the right way. Also talk about every week about keeping it simple. All right, at the moment, ladies and gentlemen, when markets are bullish, we want to be a buyer. When markets are bearish, we want to be a seller. Define the trend and trade with it. No trend, no trade. No signal, no trade. Now, I appreciate some people who are very experienced, they might like to trade sort of reversals, and that's something we'll touch upon much later down the line. But to begin with, all right, it's never a bad thing just to be reaffirmed that markets are bullish, be a buyer. When markets are bearish, be a seller. Okay, let's not try and fight that trend. So, we looked at step 1, step 2, step 3. Step 4 is then, we're looking for particular price action signals at those support resistance levels. We're looking for those confluence of events. And that's what we've covered over the last few weeks. We've looked at various price action signals, all right? And that's, we've been focused mostly on the method. And that's, we've talked about that, okay, over the last few weeks. And all of these videos are in the Admiral Markets webinar archive, on their YouTube channel, on their Facebook page. So be sure to sort of check them out as we go into them in detail on each particular session, and I give you a very, very brief run through, okay, as we build our picture. I talked at the start of it about, realistically, all trading methods come down to one of 2 styles: a break of a line of support resistance or a bounce off a line of support resistance. It's as simple as that, okay? We like to try and keep it simple, all right? And that's what we're looking for. Some people prefer to trade breakouts. I prefer to trade bounces as part of a pullback in a trend, okay? And the reason I like it is it gives me an opportunity to enter at a better price. And also, if I'm going to be wrong, I know far sooner, and that helps me manage my emotional capital, which is a critical component, which we will come on to as the weeks go on. And as you learn and develop as a trader, you'll start to realize and understand that yourselves. Excuse me. So we've looked at a range of price action signals. We went through the sort of pin bar. If you remember, it's a rejection candle. Okay, it open and closes within the previous bar. Candle wick, we're looking for it to be 2 to 3 times the length of the body. A long nose protruding from all the other bars. All right, and the better pin bars will stick out and are very obvious to you as a trader. The reason we like them is because they show rejection of a particular area or direction. We don't want to fight them, all right, let's say as a sort of a swing trader. We don't really want to fight them. What we're going to do is work with them to show us the likely short-term direction, and that gives us an idea to sort of utilize them as part of a pullback to sort of enter an existing trend. We also looked at, a week after that, we looked at the engulfing candle, okay, sometimes in an outside candle, all right, where what we see is the high and the low of the bar engulf the range of the preceding bar. So it's less frequent, but they're more powerful, and when they happen at the right place, it can signal a significant change in the trend and the sentiment of that particular market. So they become of interest to us as traders. As I said, it happens rarely, but they tend to be good high probability, and the reason is because they're demonstrating total overwhelm of the market. Okay, if we've been in a downtrend and then we get a big bullish engulfing candle, that shows that the bulls have stepped in and they have wrestled control of that market. All right, they're a reversal pattern, so there needs to be something to reverse. So we look for a bullish engulfing candle at the end of a downtrend, and we look for a bearish engulfing candle at the end of an uptrend. We trade in the direction of the close of the engulfing bar. Then what we looked at was, trading in pullbacks in a trend. We call it a 3-bar reversal setup. All right, so very simple mechanical. One would define if there's a trend, look for a pullback to support resistance. Then for a long, okay, we just needed 2 seller bars followed by a buyer bar, right? 2 red bars followed by a green bar. Or for a short, okay, in a downtrend, we needed 2 buyer bars followed by a seller bar, 2 green bars followed by a seller bar. Very, very simple mechanical, all right, idea. That was the whole idea behind it. Okay, so sometimes we, as I said, it's about trying to keep it as simple as possible, and sometimes we need to keep it very, very simple, very mechanical when we start our trading journey. Okay, as I said, 2 red bars followed by a green bar in an uptrend. All right, okay, and if that green bar, if the buyer bar, the trigger bar is is a pin bar, an engulfing or inside bar or doji, spinning top, well, that gives us more confidence all the time as well. Excuse me, a little sneeze there. So, it gives us more confidence when we see that third candle. It gives us also a bit of a price action signal in itself, all right? And that's what we're particularly looking for. So, we had lots of examples here. This is the Australian dollar against US dollar. This is a daily chart, okay, of over the summer, and we were just showing how there's quite a lot of, we can see that price is in a downtrend, price is making lower lows, lower highs. You can see that the moving averages have acted as nice levels of dynamic resistance as we've moved, and when prices got up to those levels, we can see that it's just completed like 1, 2, 3 patterns. All right, okay, so 2 buyer bars followed by a seller bar, 2 buyer bars followed by a seller bar, 2 greens followed by a red. Okay, very, very simple. Okay, just very simple. And actually, as I said, as I've said it many times, human beings, and I include myself in this, we sometimes try and overcomplicate things. We try and think, oh, it can't be that simple. It needs to be more hard. It needs to be difficult. It needs to be more complex. And in fact, actually, with trading, what you find is that the making it as simple as possible tends to make it the easiest as possible for us as well. So yeah, so that was that's what we looked at in that 3-bar reversal. Okay, define if there's a trend, wait for a pullback. Right, for a long you need 2 seller bars followed by a buyer. For short you need 2 buyer bars followed by a seller. And actually what we talked about is to begin with, as you build confidence, look for just a 1.5 reward to risk ratio for a targeted trade, which we're going to talk about more in on a few of the sessions coming up. So then last week, I think it was last week, we talked about the inside bar, right? And that was, whereas the outside bar, okay, is engulfing, the inside bar, the high and low of the bar is fully within the range of the preceding bar, right? And I talk about it as, think of it like an organism, like a human breathing, okay? Humans, we surge, then we rest, then we surge, all right? And the markets are like that. Remember, markets are a reflection of human psychology. We see markets surge, they take a breather, and then they surge again. And very often that inside bar is the rest. It's the rest before the next surge. And what we're looking to do is to catch that next surge in the market. So we put up a few charts of examples. All right, okay. Here we have the far right one isn't an inside bar because the wick of it, okay, sort of encroaches outside the high of the previous bar, right? And when I talk about the high and the low, I mean the entire candlestick, okay, not just the body, but actually the entire range of the candle I need to see inside the previous bar. And we talked also about it can be quite powerful when you see 1 or 2 actual inside bars within the sort of the main bar, the mother bar. That gives us an indication of some real strength, sort of a real surge getting ready and building for its next move. So yeah, we just had a few examples. We talked about how, you know, we like to sort of trade them in as pullback in a trend, but also, you know, you can trade them as part of a breakout. Okay, so you know but as I said, I particularly prefer them to trade them as pullbacks in trends, especially in sort of bigger, you know, let's call it higher time frame charts. I find them quite useful. I talk about you have to be aware of false breakouts. All right, sometimes, you know, we just need to sort of just have a little bit of patience to wait for it to see the mother bar being broken out of the range. You know, and as I said, I like to see, you know, with pullback, we get a confluence of events. We've got a trend happening. We have a pullback, okay, and the pullback is pulled back into, let's say, you know, in a level of resistance in a downtrend, and then we get an inside bar. So suddenly I've got that sort of, you know, 3-4 things all coming together. I've got that confluence of events, and that's actually what I'm looking for, right? That's what we're particularly aiming for. I also talked about, you know, we can work in true breakouts. Okay, we wait for the breakout to occur, then, you know, we wait for an inside bar to be printed. Remember, the surge is the breakout, then the rest is the inside bar, and then we get ready to surge again. Then you should just, that's it, surge, rest, surge. That's what you always want to be thinking about when you're seeing inside bars in the markets, regardless of what instrument or what time frame you're actually trading. So here we go, ladies and gentlemen. Here's what our main element for today. You know, another sort of series of candlestick patterns, and in particular, I'm going to look at the key day reversal and the momentum reversal candle. You'll quite often hear me talk about key day KDRs or MRCs. If you join me on the Tuesday morning real-time trading, daily trading idea slots, okay, 10 o'clock London time for about 20 minutes every morning, you'll very often hear me talk about, you know, what I'm looking at in the markets, and we'll also have a, you know, I'll also talk about, you know, if I'm seeing anything like key day reversals setting up. In particular, I like them, and I'll show you why over the next few slides. So they're actually quite similar setups. That you know, I say here that they're ideal for daily, weekly, and monthly charts, but also you'll find that you know, with all of the ideas we've talked about over the last few months, is that you know, that they will work on any time frame and in any particular instrument. But like any sort of trading idea, the higher the time frame, the more validity it has. It's a reversal idea, okay, and it can be used anywhere, but you know, we're best used to identify low risk, high reward opportunities. And what we're expecting is, you know, after a concerted move in one direction, we're looking for momentum to reverse. And as always, we're more interested when that happens at key levels. That's that confluence of events, and we can start to use some specific, you know, setups to provide an entry. So a key day reversal is a little bit like an engulfing candle in that it happens rarely, and it can signal the end of a trend, and the higher the time frame, the more validity. But what it does help is it provides clear proof that the previous trend is either very much over or is very close to its end, and that can help us enormously. So, you know, it's a sharp reversal pattern that occurs, you know, at the end of a trend. All right, so in an uptrend, price either opens above, so for something like an index or an equity, and in an FX market, you know, we get a sort of a constant close and a constant open, all right? But it's in an uptrend, price would open above or the same as the previous day's close, then price makes a new high, and then it collapses and closes beneath the previous day's low. All right, just think about that. You know, price has opened, it's pushed to new highs, and then it's fallen all the way down, and it's actually closed beneath the low of the previous day. So that gives us a real indication that there's been a real swing there, okay? You know, in an uptrend, okay, that means the bears have stepped in and wrestled control of the market. I'm not going to fight that. I want to use that information to give me an indication of the likely short-term direction. In a downtrend, the price opens the same as or below, all right, for an equity or index. The previous day's close makes a new low, and then closes higher than the previous day's high. So once again, it's, you know, in a downtrend, you know, price has made a new low before bulls have stepped in, they've grabbed control of the market, and they've driven prices higher to the extent that it's closed higher than the previous day's high. And you know, the greater the range, the volume, the key reversal day, the more reliable signal. Okay, they don't happen as often as we'd like, but you know, when they do happen, well, then, you know, then we start to take a good deal of notice. So, you know, there's a couple of examples there. Okay, you know, we can see it. Let's see if let's use some of the drawing tool here. Okay, so you know, we have one here. Okay, after a downtrend. Okay, we have, price makes a new low, but then actually you can see, it really wrestles up and it controls, and it closes higher than the previous day's high. Price sort of makes its way, moves its way up there, okay, and then it eventually sort of makes a new high, but actually closes right lower than the previous day's low before we get a move down. Okay, it's as I said, they don't happen very often, but when they do happen, we want to take good notice of them, ladies and gentlemen. And very often what we'll find is, that, a key day reversal can form in many ways. However, many times a key day reversal will also be it's a pin bar or an engulfing candle or a combination of both. And even though you'll hear me talking as a key day reversal, and that doesn't just mean that it's on the daily chart. It's just become slang terminology amongst traders, all right, to sort of talk about as a key day reversal. Some will call it a key reversal, but very often you'll hear them call it key day reversal because a lot of the people are just only trading daily charts. All right, that's their main time frame. So, but it applies to all sort of time frames. So this is an example on the Nasdaq. Okay, price has been in a lovely uptrend, and then price makes a push to a little high, but then before it actually collapses and it closes way beneath the lows of almost pretty much the sort of week, 7-8 trading days beforehand. That's a pretty strong signal, okay, that the uptrend is either at an end or very close to its end. So as I say, they don't happen very often, but when they do, we get interested. We start to sort of take notice. So here's another version of it called the momentum reversal candle. And in an ideal world, right, we'd like to see and trade KDRs, key day reversals all the time, but unfortunately they don't happen as often as we like. However, a version of them, all right, do appear much more frequently, and we call them MRCs, okay, momentum reversal candles, all right, and I'll explain the difference between them now for everybody. Once again, these are ideal for sort of daily and weekly charts, but you will find them on all time frames. But as I said right at the start of these sessions, that we're going to look at starting as if we were an end of day trader, okay? Because I appreciate many of the people watching and joining our sessions that they are probably looking to trade around a day job, and so it's about being able to sort of be a little bit of a trend trader around our day job, but what you'll find is that all of these, you'll find them across all time frames, from the 1 minute to the monthly charts. That's what we're looking for, okay? Just simple, versatile ideas that you can identify, you can work with, and you can basically meld towards your own particular trading style. Once again, it's a bit of a reversal setup, can be used anywhere, and it gives us an idea how to identify low risk, high reward opportunities, because after a move in one direction, we're looking for momentum to reverse, and I'll show you what we actually mean by that. So let's say we're looking at a weekly or a daily candlestick chart, but it's we can use other time frames. But for a buy, for a trigger day essentials, what we'd expect to see is that price is in a downtrend, price makes a new low, okay, just like a key reversal, but it closes higher than the previous day's close. Okay, so in this particular case, okay, we've got a candle here. Price has been in a downtrend. Price makes its new low here, but actually what it does is it closes here, closes higher than the previous day's close. All right, a key reversal would actually be closing here because it would be closing the previous day's high, but we don't always get that. But the fact that we've actually had a close higher than the previous day's close is a good indication that momentum is reversing. Okay, there's a bit of a swing in momentum going on, and we can use that information to help us with our own trading ideas. Okay, so it's a similar to the key reversal, but the close is a bit different, and we're working with what we see. So for a buy candle, okay, for a buy order, what we'd be looking to do is we'd be looking to have our buy order above the high of the bar, and here's maybe a little bit of the difference is that our stop loss order, all right, would be beneath the previous day or the previous candle's low. So it would actually be here, which is 0.3. So that's actually what we'll be looking. Our entry would be a break above the high with our stop, beneath the low of the previous bar, and that gives us a little bit of a tighter trade risk, which allows us to sort of to trade our way towards our target. For a sell trade, okay, for a short setup, well, what we see here is that let's get the pen on again. Price is in an uptrend, okay. Price makes a new high, but closes lower. It closes lower than the previous day's close, okay. Closes lower than the previous day's close, and that would be here. So what we can see is that momentum is reversing, okay. And also what we want is we want the high, okay, to be higher than at least the sort of previous 3 to 5 bars, and we can see that actually here. It's actually higher than about about 6, 7 bars beforehand. So we've protruded out, we've pushed out, okay, we've swung around in terms of momentum, we've closed here, and what we're expecting is that we're going to use that information to help us trade in the direction for the next few candles, and that's what we're particularly looking for. So what we'll be looking for to do is that we're effectively on this particular slide, I've got we have a sell order 10 to 20 points beneath the low of the bar. That's for like a weekly setup, but it would really just be we're looking to depending upon your time scale you trade, we would be looking to have our short order here, okay, just beneath the low of the bar, and once again our stop loss goes above the preceding bar, okay. Stop loss goes above the preceding bar, right? So that gives us a little bit of a tighter trade risk, which is something we'll touch upon in one of the future sessions. And that gives us that opportunity to sort of have a little bit of a better reward to risk in our favor. So what we look to do is that we can have our targets, all right. We're going to sort of talk a little bit more about targets in particular. For those of you who like to use trailing stops, what I normally suggest is sort of to trail on a sort of a 2-bar trailing stop. Otherwise, you can have a sort of a target based on the sort of the Fibonacci extension, okay, that of the sort of our trade risk. That's something that we'll probably look at in a little bit more depth in one of the future sessions about actually how we go sort of about trailing and trading stops. For the moment, I just want you to be able to identify the actual setup itself. That's what we're particularly looking for. So that was a particular example there, okay. We had the Euro Aussie, all right, and price had moved up from point X. It makes point 2, it makes a new high but closes lower than the previous day's close, okay, and that gives us an opportunity to sort of take a trade down towards where we were looking for. So it's it was just a bit of a swing, and we get the opportunity to sort of to look and take a trade upon that. What we've got here is a few examples, okay, trying to just put together a couple of examples where we see, key day reversals and a few MRCs as well, all right. So you can see in this particular case, this is the CAD against the Swiss franc. Price has been moving in a nice uptrend. Here, let's get the pen going. Price has sort of been moving in a kind of a nice uptrend. Then what happens is we get a push to a new high, but also we get a close beneath the low. I think so. It's it's a pretty strong move, and then actually what we saw a good concerted move to the downside, and that gave us a trading opportunity. As I said, they don't happen as often as we'd like. In an ideal world, we'd see lots of these. Unfortunately, we don't. But when we do, as I say, it's a good example, good opportunity for us to sort of to take note and get ready to sort of to trade the opportunity. And this is one particular case here that against the dollar Canadian, US dollar against the Canadian dollar, whereby we've had a nice uptrend, okay, moving up. Price makes a new high, but then actually there's a complete overwhelm, and we close well beneath the low of, in fact, the sort of the previous 3 days trading range. Okay, that's giving us a real indication that trend is either at an end or it's close to an end. And actually what we can see is price actually went into a little bit of a consolidation there, okay, for a few days before it actually broke and moved to the downside. All right, and as we come back to revisit these in a few weeks and months, we'll talk more about sort of some of the advanced ways that we can look to sort of trade them. All right, but at the moment, I just want you to be able to identify the setup. That's what's actually the important bit for us at the moment. So just a small example on a 5 minutes chart here. Okay, you can see prices in an uptrend. We got our sort of key reversal. This was on a 5 minute chart here. Okay, but actually price went sideways for a little bit. Okay, before it rolled over and we had a real fall down to to the 200 period moving average, which was dynamic support there. Okay, and then price reversed off that itself. So there's as I said, they happen across all time frames in all directions. Okay, and all instruments. Sometimes we just need a little bit of patience to be able to wait for it and to wait for our setup to occur. And a couple of examples there on the sort of euro US dollar of the weekly and the sort of momentum reversal candles and the key day reversal, key reversal ideas that what we had, prices moved up, we were in a longer term downtrend. Price hits the 50 period moving average, it makes a new high, but it closes, all right, it closes lower than the previous day's close. Okay, but it's, as you can see, it actually goes sideways for a bit. All right, and then what happens is we get a move up here again. We actually get a new high, but actually it closes beneath the low of the previous day's close. And those of you who've been joining us for a couple of weeks, okay, would notice that was also a 3-bar reversal, as was this. Okay, we had 2 greens followed by a red. We were also bouncing off that 50 period moving average in a much bigger downtrend, and then price flowed down. Price flowed down until a particular level of support, and then what we saw here is that price made a new low on that day, or that week rather, and then actually it closed way above the highs of the sort of previous 3 weeks. That was an indication that sort of that overall downtrend was at an end, and actually what happened is for the next few months actually price moved its way northwards. So as I said, excuse my scribbles, I'm a better trader than I am an artist, ladies and gentlemen, but hopefully you can get the idea of what we're looking at and what we're waiting to see. And this is an example actually from a little bit a few months back. We had oil was sort of swinging a great deal. Okay, it was making some great swings, and what we were seeing constantly was actually a price had broken out of a bigger range, and what we were seeing is that the swings were being ended by what were momentum reversal candles, but which were also, in this particular case, they were pin bars as well. Then we'd get price would rise up, and then it would form another momentum reversal candle, push to new highs, close beneath the low close of the previous day before dropping down again. Here it would put in another momentum reversal candle, which was also a pin bar, but then it would move up. Then we had it ended here as a key day reversal candle before it swung down again. So we can see this at the daily chart, but you can see that price was making some nice swings there over a good few months, over almost like a 6-month period, but that actually those swings were sort of being finished by momentum reversal candles or key day reversals, which might also be pin bars or engulfing candles. So as I said, there's pulling it all together, giving a little bit of a confluence of events is what actually helps, is what we like to see in our trades. And interestingly, about the same time, we were also seeing the similar on gold. Okay, so that the price was getting swinging, but it was also here the swing was ended by a momentum reversal candle, which was also a bullish pin bar. Okay, it started with a key day reversal here. Price swings up. Okay, then it puts in a momentum reversal candle off the daily 200 period moving average, which is also a little bit of a bearish pin bar. Okay, before price pulls down and away. Then invariably we had a momentum reversal candle. Okay, which became a double bottom, which then had a sort of a strong move away, and we moved north. Okay, until we had a momentum reversal candle here. Price it was an engulfing candle, all right, but it closed beneath the close of the previous day's candle before we swung down again. So as I said, when prices are moving like this, there is opportunity. Okay, it's just, as I said, sometimes we need to have the patience to wait for it, and I appreciate it. Sometimes that can be the most challenging aspect, but we'll talk about that as we go through our sessions. So to conclude, ladies and gentlemen, all right, key day reversals and momentum reversal candles, they provide insight into the reversal of momentum, and we can use that knowledge for a trade setup. Preferably, we want that confluence of events where we're combining levels and trend to build that confluence of events. And, in an ideal world, we like to see in trade key reversal bars. Okay, that's what we like to see because they're stronger However, they don't happen as often as we'd like, and so a version of them that does appear more frequently we would call momentum reversal candles. Remember, key reversal, in an uptrend, we will see price make a new high, but then close beneath the low of the previous day. A momentum reversal candle in an uptrend, we would see a new high, but it would actually only close beneath the close of the previous day's candle. So there is a momentum reversal going on, but the key reversal tends to be much stronger, but they don't happen very, very often. Basic traders, you can buy the break of that candle, stop, beneath the previous low, or in a momentum reversal candle, stop at the other side of the bar preceding the MRC. What I'd say to people is, to begin with, start with, a targeting of like a 1-to-1, or preferably 1.5 to 1, and that's gives you a little bit of a move. It helps you build a little bit of confidence, and then invariably, we will look at things like continuous, consistent targeting later on as we go through our particular sessions. We've covered a fair bit there, and hopefully, you can see that these will happen as we have a quick look on some of the charts. So remember, what we're talking about is, in particular, we're looking at 28 major FX pairs, okay, and the dollar index as well. That's what we're interested in. Keeping an eye on that gives us the 28 to 29 sort of pairs to look at. We're also interested in looking at the S&P, Dow, NAS, FTSE, DAX, Nikkei, commodities, oil, gold, silver, and copper. We're looking at things like the FANGs, okay, which are are available to you on with the Admiral's equities trading, and also increasingly with Admiral markets, you have also the sort of the cryptocurrency, so Bitcoin, Ethereum, Litecoin, Ripple, etc. They're all available to the traders also. So, we've got a couple of minutes left. So, just to finish off, ladies and gentlemen, remember, we're always looking to manage those 4 M's of trading: markets, method, money, and myself. Ask yourself a little quick question yourself at the moment. Are they all in alignment? If you're having a struggle or two, can you identify in it, where is it in one of those 4 areas? Because that will be the area that you want to level of focus on. Because, if those 4 aren't all aligned, then, you shouldn't be surprised if you have a little challenge or two. So constantly monitor those 4 areas, okay, those 4 M's, the markets, method, money, and myself, and utilize that to help develop and evolve as a trader. As always, if you have any questions about today's session, or about Admiral Markets in general, or particularly the platforms or the products and services that are offered to clients, then by all means get in touch with the account representative at Admiral Markets. You can call them on the London number there, 020-726-4003. Drop them an email at hello@admiralmarkets.com. But you'll also see they have the YouTube channel, the Facebook channel, where you'll actually see recordings of this and all the other previous sessions as well. So if you want to dig into some of the stuff that we talked about and we covered, by all means go back and have a look through them, and you'll find that there's a wealth of information there to sort of help improve your own particular trading ideas and knowledge. So we've got a minute or two left. I'm just going to have a quick look at 1 or 2 just things on the Admiral Markets charts, if you bear with us, okay. In particular, here we go. We'll just finish. This is sort of a chart of gold and the weekly. Hopefully, let's just check you can actually see there, okay. So kind of interested here that this was gold in a bit of a downtrend. Actually what we had here was this was a momentum reversal candle here on gold, okay. We could see price hit the 50 period moving average, closed beneath the close of the previous day's candle. It was also a 1-2-3 pattern, 1-2-3, a 3-bar reversal, as was up here, okay. This was a 3-bar reversal, 1-2-3. The third candle was actually, was a red candle. It was an inside bar, okay. So you'd have been looking to sort of trade the sort of break of the south of that, okay, with your stop above the candle above that, but it giving you a nice move down. But look where it finished. This was gold, okay. What we had was we ran down to around about that 1050, 1045 level. Price makes a sort of a new low, but actually then it sweeps up and it closes above the high of the previous candle. There's been a real, the bulls have stepped in and wrestled control. For the next week or two, we came down. We had, actually a couple of pin bars there, okay. Just price actually showing up as kind of inside bars with inside that big candle before we had a strong breakout. We had a very strong breakout there. Then we actually also had, we had a couple of inside bars there. Remember what I was saying is that a couple of inside bars after a strong confirmed breakout is a nice way to use inside bars. And then actually what happened, was we rallied up there from around about that 1080, 1100 area up to as high as 1375, and then we started to sort of run out of enthusiasm there. So that's hopefully that just gives you just a little quick insight, ladies and gentlemen. I hope you found that useful. As always, I say that if you want to sort of get a little bit more up-to-date information, then every Tuesday morning we run Admiral Markets run the real-time daily trading ideas. I do the Tuesday 10 o'clock London time real-time daily trading ideas. You can sort of attend that. Just go onto the Admiral Markets website under the webinars and the Forex and education pages and be able to sort of join us. Every time 10 o'clock. The next session will, of course, in the Mastering the 4 M's of Trading series will be next Monday. Okay, that'll be 4 o'clock London time. I look forward to you you joining me there, and I wish you the very best of success in your own trading, ladies and gentlemen, and I look forward to seeing you soon. Many thanks and good trading, everybody. Thanks, Phil. Thanks, Said. See you next week.